Hello, investors. This is Stuart Kruse from Kruse Asset Management, and I am coming to you with shaggy hair and a scruffy beard from a horse farm in Virginia so that we can maintain our social distancing but still get outside from time to time. So, coming to you about, again, why I firmly believe that there's going to be another sell-off or down leg in the marketplace. So right now we're looking at a chart from our friends at White Charts about the financial meltdown, financial crisis from 2007 to 2009. And I know I've covered these charts before, but I really wanted to put some numbers to this. So as we see, we hit a peak here and we have a sell-off and then a rally. But when we really look at the numbers, what I had was somebody asked me, geez, I really wish I had seen this the first time and had sold back in February because I told my broker I should have sold. And so now it's too late. I said, well, I don't really think it's too late. So let's look at the financial crisis. We did peak in October of 2007 and we had a sell-off of 17%. And then we rallied 10%. And that took about 2 months to rally that 10%. Now, we did this all much faster. But if we're looking at what happens after that first rally, from top to bottom in the financial crisis, we lost 56%. But after the first rally, even if we had sold right around that first rally, we still would have lost an additional 52% or saved an additional 52% of our portfolio had we sold and rebalanced at the right time. Okay, that took 294 days to unwind. And in the meantime, we had a sell-off, a rally, a big sell-off, a big rally, and another big sell-off. So we had 4 down legs before we actually hit a bottom in the financial crisis. All told, after that first rally, 52% down. Okay? The next example would be after the tech wreck. So here we're looking at 2001, 2002, 2003, thanks to our friends again at White Charts. We peaked back here in March. Sell-off, rally, sell-off, rally, sell-offs. Okay? What do those numbers look like? Well, here's the tech wreck. Again, we had a sell-off of 27% and a rally of 16%. That rally took another month and a half or so. Then we had a leg down, a leg up, and another big leg down. So after that first rally, we could have saved another 40% had we rebalanced. And that took 500 days to unwind, a year and a half. So my question to you is, if we believe that, and we know there are 22 million jobs that were lost already. Unemployment was at 13%, probably going closer to 20. GDP is down 30%. We have housing market is down. We have things like Uber drivers down. Of course, restaurants, everything at a standstill. The estimates are that somewhere in the neighborhood of 50% of all small businesses will actually go out of business. These are staggering numbers. So China printed its worst GDP numbers since the 1990s. Every single country has been affected by this in one way or another and are all going to affect us in turn. So if the financial crisis and the post-dot-com boom were mostly a US problem, and this is a global problem, do we really believe, here are the COVID numbers, as of February 19th, we sold off in 33 days, 33%. And then in 25 days, we rallied 28%. We're basically right off of those numbers. And we're only 5 or 6 days past the current peak. Do we really believe it's all over? We're down about 17% after I think today was up another 1%. So let's say 16%, we'll call it. Do we believe that there's only been 16% of market damage done to a time in February when we believed that we were going to have exceptional growth, when we believe unemployment was at full employment, under 4%, 3.5%. We were anticipating great markets and wonderful productivity. And then we are taking an about face. Do we really believe that this is all going to be said and done in 60 days? I just don't buy it. I think we're going to follow the other patterns of the markets before. I think we're going to follow a down leg, another back up, and another down leg, and another back up. We've been supported by the Fed because they had these multiple trillion-dollar packages put into place. But at some point, the Fed involvement becomes diminishing. The more they get put into the economy, the less effect it has. We saw that with quantitative easing. Quantitative easing 1, 2, 3, 4. You might argue that QE1 helped, but most economists will say as you added QE2, 3, and 4, it helped very little in the actual economy. So do we really believe the Fed's going to be the backstop? And if they are, for how long? We have no vaccine in place. The best estimate is 12 to 18 months. Even if we're starting human trials right now, but even if we had a vaccination in place, we wouldn't be able to produce it and distribute it till the end of the year. We can test and trace, but best case estimates, there was a case out of LA County that said they think when they did antibody testing that somewhere in the neighborhood of 200,000 to 400,000 people actually were exposed to the coronavirus on the 8,000 cases and 600 deaths. So what that basically means is, good news is 2 to 4% of the population has already been exposed, much better estimate than the 1% or a tenth of a 1%. And that also drives the death rates or mortality rate of coronavirus way down to the magnitude of the flu, like somewhere in the neighborhood of 0.1 to 0.2.5%, where the flu is 0.1%. So if those LA County numbers hold up and hold true for the United States, a lot more are positive and a lot more can go back to work. But still that leaves 96% of the population unexposed to the coronavirus. So that means 96% of the population still have to take precautionary measures. And we can't fully reinstate the economy. And even if we did, would everybody go back to work? I would say no. You're going to have, by definition, a group of people that are compromised or even fearful that can't go back to work, or just simply don't have a job to go back to and won't have one for quite some time. By definition, the economy is going to be crippled, if you will. And so if we believe it's only been crippled by 17%, given all that's gone on, I really think that's wishful thinking. So if you haven't rebalanced, if you still want to do some things, Kruse Asset Management has some suggestions. We have ways that you can invest in the stock market with almost no risk. It's a long-term strategy. It's out there. You can't trade it. But if you're looking in your IRA or 401k and you have a long-term perspective, you can get above market returns with almost no risk or very limited risk on the S&P 500. Happy to show you these strategies. Reach out to us at info@kruseassetmanagement.com or go to our webpage at kruseassetmanagement.com and then check us out and reach out to us, and we'll be happy to share some of these strategies with you. In the meantime, make sure you subscribe to our YouTube channel and our Facebook page, and we look forward to putting the next video out for you. Thanks. This is Stuart Kruse at Kruse Asset Management signing off, and I hope you stay safe out there.